Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 12.86% year to date. Currently, we have a yellow for the stock market strength color signal. Last week, the S&P 500 gained 1.91% and had a very good candle. We'll go through the charts in much greater detail. Here on this weekly chart, I can see a negative divergence. You can see that the prices have increased. Well, here on the volume, there's a volume has been going down while prices have been going up. Last week, we made two trades. So on 7/1/24, we ended up doing an in-the-money covered call with two contracts because we have 200 shares of SPY. So we sold two in the money covered calls with the October 18th, 2024 expiration. So that's right at the end of the summer doldrums with the 490 strike because it's in the money. When we did that, we sold it for $63.40. So we pocketed that money right there. And we also bought to open one long put position, and the expiration went out June 20th, 2025, 490 strike, and that cost us $11.60. Okay, here are the trades that we have made in 2024. If you want to see all my trades going back for the last 3 years, you can head over to this link. It will be down in the description down below. Now, we have some open positions. We still hold 200 shares of SPY. We're profitable in that position by $13,378. We have also sold two in the money covered calls. I should have put the number 2 there because it's two. Well, I'm sorry, it's two contracts. I have that right here. Number of shares 200. And when we did that, we pocketed some cash because we sold them for, let's see here. We sold in the money covered calls for $63. So at the time, we pocketed like $13,000. Then because the market has gone up and it's a call, and the purchase price, if I wanted to buy it back and close it, goes up. So the numbers are a little bit skewed for an in the money covered call because it's a little bit different. But basically, I've lost money if I was to close out the position by an incredible $1,536. The market's only gone up 2% in the last week. I'm a week old in the trade. And if I was to close that out, which I have no intention on doing, then I would be losing 10.8% on this $14,000 position, $14,000. But like I said, I don't have an intention to do that. We are going to hold this position until the end of the summer doldrums. And we're going to let this play out. And the expectation is the market will have a correction. I'll show you that also later on in the presentation. In addition to that, I was debating on whether to buy 1 or 2 puts. And I thought, I know from a seasonality basis, the current month of July is a strong month. I thought, well, even though things were looking sour 1 week ago, I thought I'll just play it conservative and do 1 put, which is all I purchased. And that cost me $1,160. And we're currently negative on that because the market went up 2%. So we are negative $165 or 14% in that $1,160 position. Overall, though, the portfolio did gain a little bit from last week to this week, even though the market went against me because I was getting some time premium for everything that's happening, as well as that I'm getting, if I was to close these out, some appreciation on the stock position that is increasing. So if I was to close everything out today, this is where the portfolio would land, which is a very small percentage base increase from last week to this week. If you want to see how I trade this portfolio, go ahead and smash that like button down, subscribe to my channel, and ring that bell. Now here is our equity curve for the model portfolio in blue and for the S&P 500 buy and hold investor in pink. Now they did have a pullback here and then they've been on a nice tear. Last week you can see how strong that went up that way. Because we took we're expecting a pullback, we are not going to participate in these gains till we close out that in the money covered call. Now we are looking at a 6-month short-term chart daily candlestick of the S&P 500. Here on the MACD, you can see a negative divergence. So prices increased while the MACD has gone down during this same time frame. We know that it was the 4th of July this week. The 4th was closed. The 5th, which is our last trading day, is usually a little bit tapered on the volume, although here it doesn't look that bad. It looks like it's still somewhat in line with expectations. But it was a nice candle. You got to give credit where credit is due. So we got to monitor this and see how the market is going to react starting as early next week. Now we are looking at a ratio chart, NASDAQ 100 to the S&P 500, and we are in the stratosphere. I mean, we're in practically straight vertical. The ratio chart is the one that's in red and black. And there is resistance and support lines of the trend channel that we're currently trading in, and we are at the upper end of the channel and hitting resistance. Expectation is a little bit of a pullback. Now we are looking at the VIX Volatility Fear Index, 3 ranges, ultra low range, and then the upper bearish range. We are in the ultra low range down here at rock dead bottom. The MACD is floating around towards its signal line. The slow stow has bottomed, ready to come up. Who knows if that's going to jump up. If it still hangs out down here, that's still not bad for stocks. For stocks to pull back, they need to jump up into this zone and then eventually into this upper range for us to make money in our current positions. So we're way early in the trades that I made. Now here's the reason that I made those trades. We're looking at the seasonality of SPY going back 5 years and going back 10 years. Now we know that for the month of July, there's a 100% probability that you're going to be closing the month higher than when you opened the month. Well, we've already accomplished that. The market's about 2% higher for the month of July. But the following 3 months is what's called the summer doldrums, August, September, and October. Going back 10 years, you can see that your percentages drop off of a cliff compared to July. And in September, going back 5 years, it's almost a for sure thing that we are going to go negative on that particular month. But our in the money covered call takes us all the way to October 18th. So we're going to capture this entire time period with what we already have. The expectation is that there will be a pullback. Yeah, the only question is the severity and how much. Now, I will take on another put position, but I will not take it on until I start seeing the trend absolutely go through a reversal. I was early in the trading with my in the money covered call and the put, and that's why we're upside down on those positions. So now we're just going to sit tight until we start seeing clear signs of a market that's traveling south. Okay, right now we are looking at a 3-year weekly chart of the S&P 500 in candlesticks with standard deviations. We have the +2, -2 in gold, the +1, -1 in pink. Currently, you can see where we are at right there. And I also have in here a Fibonacci extension in which I had a target zone identified, and we have just hit that target zone. Now, we are very, very high on the standard deviation chart here. So the room, how much are you going to gain between the +2 standard deviation and where we are currently at? The amount that you can gain profitably before you start backing off on this market, there's just little room for gains here in this chart. So that's why I was, I took those bearish types of trading. That's why I took those positions on, because I felt like it was going to go in that direction. So that's where we currently stand. We also have in here our cycle brackets. So we have this low representing that low, this low is that low, this low is that. Now here you had a nice positive cycle, and you can see how we went higher in the chart here. Very nice cycle here with the right hand translation, and then you pull back, you go from here to here. You can see how strong that advanced. Now here we are in this cycle right here. So we are coming up here. Now if I take this and just go straight down on that chart, oh, that's about straight down, right about like that. And we're still on the left hand side of this cycle bracket. Once you get past the halfway point here, then there should be a little bit less energy taking you further down, coming out over that way. So let's just see when that cycle bracket shows that it's going to end. Hold on. Come on, computer. All right, so that is an ending on 11/24/24. So that takes you all the way out to November 24th. Now, our in-the-money covered call is going to close out before then. Depending upon how the market reacts, we can always roll that out longer for another month if we wanted to. But right now, what we need to see happen is we need to start to see the market start to go sideways and start traveling south before we do anything. I'm expecting very little upside movement before this market starts to see that, because we are very close to the +2 standard deviation. So that's where we stand with this 3-year weekly chart. Now let's head over to a daily chart. So we're going to head over and do a 1-year daily and change our cycle brackets to daily this way. And here we've got a little bit going on. Let's just bring that chart down a little bit. Now here you can see that we've reached some really good levels. Here, where it is at, almost is hitting the 100% on this Fibonacci extension going on right there. So there's the profit has been made in this move right now. Now we do have a valid trend line from this low to this low. Oh, let's see, that low would probably represent that one, and this one is right around that one right there. So this trend line, as long as it's intact, is still going to be somewhat bullish. Now we are getting closer here to the +1 standard deviation, but due to the Fibonacci retracement, how much we've advanced, I'm expecting the market to begin to sideways to down, as you know. So that's my expectation. Just because I expect it, though, doesn't mean it's going to happen. That's why my trades are very conservative in nature. So it's just, I'm not going to really lose money, but if the market does continue to advance, I've limited myself on upside gains. But I'm not expecting much more gains happening before the summer doldrums begin to take effect. All right, now we are looking at an Excel spreadsheet that I created in an effort to get an idea of how strong different asset classes are faring in this market, and also breaking down the 11 sectors of the S&P 500 and see how each one of these 11 sectors is doing. And here's the information that I'm putting into the chart, and you can see it up here as well. And then that comes down to a number, with 6 being the highest number that you can get in this chart. So if the number was a 5 or a 6, I label it in green to show you that it's a green moving forward and a lot of green energy, positive energy for this market. Now this market has come up. Last week, the 11 sectors was dropping down to 45. Well, now we're at 59. Well, if that reaches 60 or higher, if we go to 61 or higher, we're going to change from yellow to green, and we are very close at 59. This one already did change last week, 57, this week 76. So we're seeing increases in strength across the board here. If that continues, we're going to go green on the S&P 500 here, which ironically isn't going to help me any, unless of course I want to take on a call or something like that. But right now I'm just going to sit tight because I think last week was a very strong week, out of the ordinary, so to speak. Now we are looking at a chart for the 10-year bond yields, and here we have dropped down and we came down to a low level. The market is going to like that, so the market should continue to move sideways to north if it stays down here at this level. When the market started to rise up, that's when the market started to drift sideways, but then it hit a ceiling here and came down. And it's showing that you've lost momentum on the MACD and slow stow, not really telling you that you're going to be bouncing up. So it looks like we're going to stay down here, which so far is looking good for SPY. That is going to conclude my presentation. Now comes the critical thinking. What are we going to do with the information presented in the video? I already told you what I'm doing and how and the reasons why I'm doing it. So July 6, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now. The market strength is increasing, but we still have the yellow signal. The summer doldrums are starting in August and till the end of October. Our positions are set to profit off a market pullback, but we're missing out on market gains till we close out of that in the money covered call. If the market starts to decline, I will probably take on another put because I want to get more profit as this market does tank. But I need to see signs of that happening. Remember in one of the slides I showed you that valid trend line? Well, I want to see the market break that valid trend line and stay underneath it. If it starts doing that, that would give me the first sign that, okay, we are starting to lose strength in this market. But until then, I'm probably not going to change anything. Now, if the market does continue to advance, maybe I'll even consider leaving everything in place and purchasing a call, a long call. But right now, I'm tabling that idea until I see how the market plays out. I hope you got some valuable information out of this video. If you have not done so already, smash that like button, subscribe to my channel, and ring that bell. I thank you and wish you good trading.